the decision you're about to make, it's not worth the risk.
Learning the hard way is never a pleasurable experience, but sometimes it is the best way to learn. Staying wary of risk, always digging deeper, and fulfilling a fiduciary responsibility are examples of this.
We want to emphasize that our mistakes are not indicative of our skill level, but merely represent our time in industry. We recognize that these choices will make us better analysts going forward.
Now, I would like to invite up Adam, Chris, and Megan to conclude our presentation.
Now that we've walked you through both the value and growth sides of our lives within the cafe, we hope that you understand the undeniable commitment that we have made to bettering ourselves as analysts. Unlike at other undergraduate universities, we have the rare opportunity to work in real time with real money, taking on the real responsibilities associated with being an industry professional. Now, being in industry doesn't mean that we just watch markets and write opinions. We research, forecast, and invest based off of our own efforts. Just this past week, we decided that our holding in New Oriental Education no longer fit our growth profile. After getting group consensus and Doc's approval on a name from our buy list, Kristen, Ryan, and I placed the trades ourselves, adding Starbucks to our growth fund.
At most of the academic institutions we compete against, such a trade could never happen in real time. As a student, we need to wait for board approval, as well as a third-party industry professional would have to execute the trade for them.
This autonomous environment is an everyday part of our lives within the cafe as it prepares us for industry, because the markets never sleep, so neither do we.
The cafe program has impacted each student fund manager differently, but I'm confident in saying each and every individual standing before you is truly proud of what we've accomplished this semester. Every day we were faced with new challenges that we had to overcome, and that is truly indicative of life in the real world. We came into this semester as a group of strangers, but after the long hours and grueling all-nighters, we are leaving as one inseparable family. We'd now like to take the time to give a special thank you to a few individuals who are truly deserving of this recognition.
First, the associate directors, Ryan Lambert, Luke Nigro, and Carlo Puccini. They were once student fund managers who exemplified a level of leadership, skill, and knowledge that has earned them this distinctive position. Thank you for helping to guide us through this extensive program.
Second is our conductor Maria Manning and our videographer Colette Alcasab. These two exemplify all the qualities that CAFE represents, and we're extremely fortunate to have you two on our team.
And last but not least, our director, Dr. Michael Melton. He's the foundation of this organization. In the industry, academic, and life lessons that he has taught, we carry with us long after our time in CAFE concludes. Doc, you're an inspiration to us all, and we cannot thank you enough.
We'd like to thank you for listening as we walked you through our world, and would like to open the floor to questions.
Great job, guys. That was a really good presentation. I'm just curious how you think the Trump rally is going to pan out for your fund and for the market as a whole.
So obviously we saw a windfall in our financial sector. I mean, if you just look at our returns, Bank of the Ozarks actually hit over 40%. I think it's 40.6 now. Deutsche is over 35, and Wall's over 27. So obviously we saw a windfall from that. And then there is a number of areas that we also benefited from. First off, when he said that he wasn't going to completely repeal the ACA, we saw UNH take off. And then going forward, I think it's important to remember that the person that's going to influence us the most is whoever's chairing the Fed. So that's who we're really paying attention to.
Congratulations, guys. That was really a fantastic presentation. And obviously I speak for everyone in this room. We know how difficult it is and how much effort you guys put in. So I'll give you guys a hand. That was a really, really incredible presentation. I do have one question. In terms of pioneer natural resources, I really enjoyed that you guys talked about pulling undervalued assets and looking at kind of the equity value from the fundamental aspect. Taking on a company that's trading at 180 times earnings, can you guys explain that?
Yeah, so we'll talk about a little bit for their earnings. It was negative for the first 3 quarters from December to their second quarter this year. So there was a little discrepancy there between their price to earnings. So it was on that negative. So the way they value their debt management is extremely valuable in the area they're in. and the production rates in the Permian Basin are fantastic. So what with that jump from negative to positive was, it was a little bit too much for them, but we mainly invested them because they're the only one that really was going to get that huge production and that supply increases on the world. So that's what we kind of invested in for that main reason.
Yeah, and then I mean, the energy market as a whole, when looking at fundamentals, is really rough. There's not many companies that are trading the PE that's actually justifiable. So another thing that I know Corey is really excited about is their break-evens. They're in the Permian Basin in West Texas, one of the cheapest oil fields. So they have a much lower break-even point than ExxonMobil, anyone else dealing in like in other areas. So, you know, it was a really great book for our growth fund.
I think it's also important to note that they're not extremely highly levered. As LIBOR is actually about to break 1%, we're going to see these debt and these interest coverage going up, and we weren't positive about the liquidity coverage of other companies in energy, but it appeared that PXD was very set going forward. So.
What mainly was strong about them, their balance sheet just passed all their peers. So.
Excellent, thank you.
I noticed in your value fund, one of the tougher performers, you done a great job. I noticed in your value fund, one of the tougher performers has been the gold ETF. What led you to believe that gold was undervalued and what makes you still think that?
Yeah, absolutely. So the main reason that we hold gold is to hedge against the market. It usually trades as a divergence from the market, so that was the main reason that we put it into our fund. We weren't looking at the actual fundamentals. Even though it's trading at a near historic low, the main reason that we did that was just to hedge against market risk even further.
Is there a reason why you don't use the VIX for gold for hedging?
It's high, obviously. The VIX monitors the volatility in S&P. I mean, there's so much discrepancy between that. I mean, you can jump 4% and drop 4% in a matter of 2 days. So we thought gold was a way better hedge to negatively correlate with the market.
Yeah, the standard deviation for gold is far less than that of the VIX.
I had 2 questions. The first is, I think you indicated that for the growth fund, that you were responsible for basically rebalancing or restarting the holdings effective at the beginning of the semester, but you showed performance year to date. Can you talk about what the performance was for the holding or since the start of the semester relative to the appropriate benchmarks?
We haven't actually calculated just during our holding period, typically because it's such a short time frame. It's only 3 months, so it's really hard to give a reflection on what we've done, especially because the beginning of the semester is more of the class, it's lectures, kind of learning the process of fundamental, technical, behavioral analysis, and actually constructing a portfolio. So what we do is year to date, because it's just a longer time frame, and it's better to show rather than what the 2 months that we've held the growth fund that we made. So that's really the reason.
Second question I had was, you indicated that I believe you sold Edwards after its earnings, and I think the same for Becton Dickinson. I know those are 2 quality companies that have, historically pretty consistently met expectations or exceeded expectations, well managed, good product portfolios, etc. Can you talk about the analysis that you've done on both those companies and why you sold them rather than maybe add to your positions after the earnings results and the stock declines?
So what happened was, particularly with EW, we were listening to their earnings call, and I mean, as she said, everything sounded great, and they were kind of victims of their own stellar performance in the past, because they raised guidance for the 3rd time that year. But they saw a slowdown in the French division. They saw high single-digit growth as opposed to the globally accepted demand, which is about 20% growth. So essentially what happened is analysts determined that as the time to drop their growth designation. And so we saw that drawdown, and we didn't see any short-term catalysts as we look forward in our growth fund to really see price appreciation in the next 2 months.
On the other hand, with Becton Dickinson, we were very snake bitten with it because we'd seen companies like Amgen, EW, and a lot of other healthcare companies drop significantly for very little minute reasons, and we did not want to take the risk of it because with earnings, you don't predict the stock 10% stock outs don't work because we can't trade post-market. So that's what happened with EW is that it dropped 20% post-market and we had to take it. So we refrained from it and sold it, even though the upside was not, our downside outweighed our upside for that one.
In regard to
future cafe program especially, what specific countries do you think you would be investing in within the rest of Trump's tenure as president, especially in the next 1 to 3 years per se?
So, I mean, it's kind of coming out how his relations are with globally. I mean, we'll find out more. It's really uncertain right now what his relations going to be with China or Mexico or his top trading partner, especially Mexico. So we're really uncertain. We might stay just domestically for now, but that's on safe aspect.
Yeah, so if you've been watching the news, I'm sure you've seen there's been a lot of shakeups as of late. First off, Xi Jinping, the chairperson of the Communist Party in China, has come out and basically said that there's too much corruption still, and he's going to increase his corruption controls. On the other hand, you have Theresa May's own party in England questioning all her decisions on Brexit. And then you have Holland, who is about to exit the French office. And so you're sitting there and you're looking at these international markets and seeing how they react. And there's just so much uncertainty in the short term. So I would say that you need to figure that out when it comes time, because to be completely honest, we can't tell you because the indicators aren't working as they should right now.
Where do you see the healthcare and pharma sector going in the near months with all of the turmoil, Scarelli kickoff and EpiPen situation? And the second question would be, after that, the newly established real estate sector. Where do you see that going in the coming year?
To first kind of touch on REITs, we kind of touched on the presentation how there was really a defensive run over the summer. You saw these high yielding stocks really kind of trade like bonds as everyone was kind of just searching for that yield. So right now, like we said in our value fund, we don't hold one currently because